PROF.SURE.U.D, Atcfoem Technical Campus, MBA College, SAS, Ahmedabad. Last 3-4 lecture, we can understand about the subjects International Finance Management, and the topics are given for the priority condition in international finance. In the priority condition in international finance, we can discuss about the 3 topics. First is the one law of price. Then we understand about the how to stabilize the law and how to forecast the law. Then we understand about the exchange rate equivalent. It's a demand and supply rules and how are interconnected between each of them. We understand it. Then some of the factors are also we understand about the exchange rate, transportation cost, inflation rate, interest rate, government debt, government intervention, political risks, market risks. So much factor we can understand about the last lecture. Then today we'll discuss about the topic forecasting exchange rate. What is the forecasting exchange rate? It's a simple meaning for the prediction. Predict the currency exchange. We know about the forecasting. Forecasting means it's a prediction. What to do, what not to do. Everything is a prediction on the one basis of the one country to another country. We also example for example money currency exchange. India in rupees to USA as dollar. This example currency exchange in India is rupees and to another country is dollar. So US is dollar. Then our currency exchange to one country to another country. It's a exchange rate. So we can predict currency exchange rate. Then so much factor are importance in the forecasting exchange rate. The first is a hedging decision. Second is a short-term financing decision. Third is a short-term investment decision. Third, capital budgeting decision. Fourth, earning assessment decision. And last is fifth, earning assessment decision. And last, long-term financing decision. One by one, we understand about what is the hedging decision, short-term financing decision, short-term investment decision, capital budgeting decision, and the earning assessment. And last is the long-term financing decision. So let's start. One by one, we can understand about the first is a hedging decision. What is the hedging decision? Hedging decision, it's a short-term financing decision. It's a short-term. It's a financial strategy. For assets. Hedging decision is a financial strategy for the assets. Then we also know about the securities, stocks, debenture, and bonds, commodities. In the hedging, we are investor for the companies, for the institution, financial institution. It's a financial strategy for the assets, and they are included as securities, stock, debenture, bond, commodity, etc. Then we can also also understand about the what the hedging is. It does not reduce the risk market. Hedging decision you can predict does not reduce the risk. It's a prediction. It's not about the flexibility. It's a prediction. It does not reduce the risk. It does not reduce and the market flexibility. We understand about the hedging. Hedging is the investment market. It's all about the investment market. Then the second is short-term financing. Short-term financing decision. In the short-term financing decision, we understand about the it's the first approach. We also understand about the budget finance, other money traps, any other loan procedures. We understand about the short-term loans. Then our approval is so fast approval. Fast approval in the short-term financing decision. Then also pay less interest. When you purchase the short-term loans, financial decisions in the financial market, we can pay less interest. Means what? It's a less uh, less interest for the short-term financing. Then we also about the flexibility to reduce the stress. It's a flexibility. Flexibility to reduce stress. When you short-term loan, you can flexibility and the reduce the stress because our currency will be not more than our expectation. Then flexibility is important for the short-term financing decision. Then last is improve credit rating. We can also improve credit rating. When you purchase loan short term, then your repayment schedule is a very improvement for the our credit rating system. They are in the points are the given the short term financing decision. Then next is the short term investment. The third is short-term investment decision. In the short-term investment decision, owner can quickly access. What should? It's a owner for quickly access. When you invest one particular spot, you can invest for your honor basis. He quickly access to your loan, and you can predict very good for the forecast exchange in the stock markets. Then have a low risk. What's it? It's a have low risk. When you in the predict short-term investment decision in a financial situation, you have a low risk. It's opposite for the long term. It's opposite for the long term. Have more maximize risk. For example, in Indian company Punjab National Bank have scan for the Nirav Modi 11,000 crores. Then it's encrypted the code and the risk is the maximum because the currency is more than 11,000 crores. So risk is the more. Then safe at small return. Safe at small return. It's a when you repayment our plans, then your payment should be small, and you can easily transaction between the institution of financial. Then your small return always your positive. Then investment must be liquid. Investment must be liquid in short term. When you invest in your liquidity for the raw material, then purchasing machinery, then and any other things you can purchase for the company, that your investment must be liquid in a short term, not to it's a surplus for the your account balance sheet. Then it's also hedge for the short term investment decision. Then four, we understand about the four capital budgeting decision. Capital budgeting decision. In the capital budgeting decision, we are evaluating the potential. What is it? It's evaluating potential expenditure. Evaluate potential expenditure. You can evaluate everything for the research. You also similarly for the research capital for the your capital. You know, firm with everything evaluate one in one research. Then you can budget it for the everything, and you can evaluate your the potential. What the potential you can budget it with the expenditure and to the manners. Then invest current funds. Invest it's a capital. Sorry, it's a capital funds. When you invest in a capital fund, it's a mutual fund, like that mutual fund. Uh, Both of the companies are in a mutual manner. Their capital are fundraised in the Bombay Stock Exchange, American stock market, Hong Kong stock market. They are invest in the capital for the stock markets and securities our budgeting. Then it's a deposit modification. Modification. What told modification? It's a updation. It's a new updation for the generation. For example, Reliance. Reliance is a modification our oil policy, telecom sector, mall. They are updation because when they updation, capital budgeting, they increase our expenditure. So it's a modification. It's an important prediction for the forecasting evaluation. Then replacement fixes. capital budgeting, you can invest one thing, then you can replace for the your fixed asset, and you can alternative options are created. For example, Reliance goes to oil, but he can alter cinema hall, shopping complex, and mobile sim. He can alternate for he can replace not to one thing is stabilized cinema hall, shopping mall, and mobile sims. And the last one we discuss about the long term investment, long term financial decision. In the long term financial decision, we can capital structure. It's a capital structure. It's a capital structure. Dividend decision and working capital management. Working capital management. Capital structure for the market structure. Dividend is a division between the long term for the year by year, and working capital. Working capital means it's a unpaid bills. So we understand about the forecasting exchange rate. So thank you very much for the lecture.